The amount allocated to each separate performance obligation reflects the consideration to which a vendor expects to be entitled in exchange for transferring promised goods or services to the customer. This is the textbook definition. In this definition, you will notice use of word expect. That means a scope for doing estimate is open. Standard states that transaction price should be allocated to each performance obligation on the basis of their relative standalone selling price. So, standalone selling price is the default method for allocating transaction price to each performance obligation. However, standard does not preclude use of other methods to allocate transaction price if that is more appropriate. Standalone selling price is the price at which you would sell a goods or a service separately to a customer. In simple words, this is the market price of the goods or service. The best evidence of a standalone selling price is the observable price of a goods or service sold in similar circumstances and to similar customers. When standalone selling price is not directly observable, you should make an estimate. Let us take an example to get our head around this basic concept. You signed a contract with ABC Limited to sell them product A, B and C for a total consideration of $500. Standalone selling price for each of the product A, B and C is $100, $200 and $300 respectively. In this case, transaction price, which is $500, will be allocated to each performance obligation A, B and C on the basis of their standalone selling price. So, first you determine relative percentage of a standalone selling price across all the three products, which is 17%, 33% and 50%, and then allocate transaction price, that is $500 in that ratio across all the products A, B and C, and thereby price allocated to product A is $83 and price allocated to product B is $167 and price allocated to product C is $250. Totaling $500, that is total value of the contract. This is the key idea with respect to allocation of transaction price to each performance obligation. That is, by default, transaction price has to be allocated to each performance obligation in the ratio of their relative standalone selling price. Now it's time to get into some detail and look at some other aspects of transaction price allocation. Discussion on transaction price allocation can broadly be categorized into three main topics: allocation based on a standalone selling price, how to deal with discounts and variable consideration, and finally, how to deal with change in transaction price. Let us take each one of them one by one. Standalone selling price. Like we said at the very beginning, allocating transaction price on the basis of relative standalone selling price is the default method for doing transaction price allocation. However, at times, standalone selling price may not be readily available, and in that case, you will have to make an estimate of the standalone selling price. To estimate amount of consideration expected to be received, use all available information including market conditions, vendor-specific factors, and information about the customers or the class of customers. So approach is like this. Ask if a standalone selling price is readily available. If answer to this question is yes, then use the standalone selling price to allocate the transaction price to each performance obligation. If answer is no, in that case, you will need to make an estimate of the standalone selling price, and Standard has suggested three approaches to do this estimate: adjusted market assessment method, cost plus margin method, residual method. Market assessment is basically finding the price which is customer willing to pay for similar goods and services in the market. Cost plus margin is basically adding market-based margin to the estimated cost of fulfilling performance obligation. Cost plus margin approach is more appropriate where there is no readily available market for the promised goods or service and you can reasonably make an estimate of the cost needed to fulfill the performance obligation. Cost plus margin approach is easy to apply, and at times this is the only way to determine standalone selling price, for example, in case of government contracts. Residual approach is not a free choice, rather this should be the last option to be used only when you cannot estimate standalone selling price by the above two methods, or even if you can estimate there is a wide range of variability in the prices. Let us take an example to understand residual approach. Say you have a contract with P Limited to sell product A, B and C for 100K. Standalone selling price for A is 50K. Standalone selling price for B is 35K. But for product C, there is no readily available market, nor you can make a reasonable estimate of the cost to use cost plus method, and therefore Only method left to you is to use residual approach to allocate transaction price to product C. Using residual approach, transaction price allocated to product C will be 15K, that is 100K total contract value less standalone selling price of product A 50K and less standalone selling price of product B, which is 35K. Like I said at the very outset, residual approach has to be the last option to allocate the transaction price. Please also note, if a discount is allocated entirely to only some of the performance obligation in the contract, then discount is allocated before applying the residual approach to estimate standalone selling price of any remaining performance obligation. Discount and variable consideration. Standard has prescribed a hierarchy to allocate discount and variable consideration, which states that you should first allocate variable consideration and should then allocate discounts. Since it is possible that discount itself can be variable consideration, therefore, when dealing with discount and variable consideration, while doing transaction price allocation, you should first determine if discount itself is variable consideration, and if so, it is then variable consideration and should be dealt with as such. Variable consideration may be related to all performance obligations in the contract, or this could be related to only some of the performance obligation in the contract, or this could be related to a specific performance obligation in the contract. If variable consideration is related to all performance obligation in the contract, then it should also be allocated to all performance obligation in the contract. If it is related to some of the performance obligations, then it should be allocated to performance obligation which this relate to, and if it is related to only a specific performance obligation, then it should be allocated to that specific performance obligation only. You need to do this allocation using appropriate method, meaning here you will need to make some judgment to decide upon most appropriate method. On the other hand, if discount is not variable consideration, then you should allocate discount to all performance obligation on a proportionate basis unless you have evidence to support that discount is applicable to a specific performance obligation only, and in that case, you can allocate discount to that specific performance obligation alone. Please always remember, discount is allocated after allocation of variable consideration. Change in transaction price. Change in transaction price could be the result of a contract modification or otherwise. If change in transaction price is due to a contract modification, then more evaluation will be needed. So, you should first evaluate whether change in transaction price is due to contract modification or not. Let's first look at what if the answer is no. This can happen in case, for example, when uncertainty with respect to variable consideration has been resolved. In this case, you should allocate change in transaction price on the same basis as you did at the contract inception. On the other hand, if change in transaction price is due to the contract modification, then you should further evaluate if modification is treated as a separate and new contract, and if so, this is a new contract, a new 5-step cycle begins. A contract modification is treated as a separate and new contract only if addition of promised goods or services are distinct and resulting change in price is the same as standalone selling price of the additional goods and services at the date of contract modification. On the other hand, if answer is no, then you should further evaluate if existing contract is terminated and a new contract is created, and if yes, then allocate change in variable consideration to the existing performance obligation, that is pre-modification performance obligation, to the extent applicable, and allocate a remaining change in transaction price to performance obligation in the modified contract. Existing contract will stand terminated and a new contract will be created if either addition of promised goods or services are not distinct, or resulting change in price is not the same as the standalone selling price of the additional goods and services at the date of contract modification. If existing contract is not terminated and a new contract is not created, then allocate change in transaction price on the same basis as at the contract inception. This will usually be associated with the resolution of uncertainty with respect to variable consideration. Please note that change in standalone selling price after contract inception has to be disregarded altogether. This means change in standalone selling price after contract inception will not alter allocation percentage when reallocating transaction price to the performance obligation. I think we need an example to dispel the fog. So here we go. Say on January 1, 20X1, you signed a contract with the rail company to deliver 200 units of rail wagons at 100K each. Contract also provided to pay an incentive of $2 million if all 200 units are delivered within 30 months, that is by June 30th, 20X3. At this time, you are not able to make a reasonable estimate if all 200 units will be delivered within the 30 months. Since you are not sure if you can meet 30-month deadline, therefore, in your initial estimate of transaction price, incentive amount, which is variable consideration, will not be included because you only include estimate of variable consideration in your transaction price, for which you have a very high degree of certainty to receive. The standalone selling price of a rail wagon on January 1, 20X1 is 100K. 2 years later, on December 31st, 20X2, you had delivered 150 units of rail wagons and you received a change order to deliver another 40 units at 95K each. Contract also increased incentive amount to $3 million provided all 240 units are delivered within 36 months from the original contract date, that is by December 31st, 20X3. Standalone selling price of a rail wagon on December 31st, 20X2 is 105K. Everything was relatively simple and straightforward until December 31st, 20X2, when you received the change order. You got a change order to deliver another 40 units of rail wagons at 95K each, and incentive amount was also increased from $2 million to $3 million provided you can deliver all 240 units in 36 months time, that is by the end of December 31st, 20X3. By this time, you have already delivered 150 units of rail wagons, and from your operational evaluation, you are quite confident that you will be able to deliver remaining 90 units by the deadline, that is December 31st, 20X3. And this basically changes quite a lot of things. So what will change because of this change order? Firstly, you can now include incentive amount, which is a variable consideration, in your transaction price because you can now predict with high degree of certainty that remaining 90 units will be delivered by the deadline, that is December 31st, 20X3. Incentive amount to be included in the transaction price will also be new amount, which is $3 million, because this is the newly agreed amount that replaces the old amount altogether. Secondly, existing contract will be terminated and a new contract will be created to deliver remaining 90 units. This is because additional 40 units of rail wagons are though distinct, but agreed selling price is not the same as standalone selling price of the rail wagons on the contract modification date. The standalone selling price of the rail wagons on December 31st, 20X2 is 105K, whereas agreed price is 95K. Thirdly, incentive amount, which is variable consideration, will be allocated between 150 units delivered to date, this is your pre-modification performance obligation, and 90 units yet to be delivered under the new contract, that is performance obligation under the modified contract. Incentive amount allocated to 150 units delivered to date will be immediately recognized as revenue also. And finally, revenue for remaining 90 units to be delivered under the modified contract will be recognized at a revised selling price, including incentive amount, as and when rail wagons are delivered to the customer. So, what we need to do? We need to calculate incentive amount that will be allocated to 150 units delivered to date and need to calculate revised estimate of the selling price at which revenue for 90 units will be recognized as and when they are delivered. So, first, let's calculate incentive amount per unit, which is $12,500, that is $3 million divided by 240 units. Incentive amount attributable to 150 units delivered to date will be allocated to this and will be immediately recognized as revenue. So, revenue recognized to date will be $16.9 million, which is 150 units times 12,500 incentive per unit plus 150 units at 100K each, that is agreed base price in the original contract. Next, we need to calculate estimate of price at which revenue for remaining 90 units to be delivered under modified contract will be recognized, and this is 110.3K per unit, and here is how this has been calculated. 50 unit at 100K each, this is the price agreed under original contract, plus 40 units at 95K each, this is the price agreed in the change order, plus incentive for 90 units at 12.5K, and then divide sum of all by total units, that is 90 units, and that's it. Time to wrap up now. With regard to transaction price allocation, there are three key aspects: allocation based on a standalone selling price, allocation of discount and variable consideration, and allocation of change in transaction price. Allocation based on standalone selling price is the default method. So if you have observable selling price available, then just use the relative standalone selling price to allocate transaction price to each performance obligation. If observable selling price is not available, in that case you need to make an estimate of this standalone selling price, and to do this you can use one of the following three methods, whichever is most appropriate: adjusted market assessment method, cost plus margin method, or residual method. A residual method is restricted to use only in circumstances where a wide range of price is available or a standalone selling price is not available at all or cannot be estimated. With regard to discount and variable consideration, first decide if discount itself is a variable consideration, and if it is, then discount will be treated as variable consideration, and you should allocate this to either all performance obligation or some of the performance obligation or to a specific performance obligation as applicable using appropriate method. If discount is not variable consideration, then you should allocate discount on proportionate basis to all performance obligation unless you have evidence to support that discount is applicable only to a specific performance obligation, and in that case you can allocate discount to that specific performance obligation alone. Please always remember that discount is allocated after allocation of variable consideration, meaning first you need to allocate variable consideration and then allocate discount. With regard to change in transaction price, first determine if change in transaction price is due to a contract modification. If no, for example, uncertainty with respect to variable consideration is now resolved, then allocate change in transaction price on the same basis as you did at the contract inception. But if yes, then further evaluate if modification is treated as a separate new contract, and if yes, then treat this as a new contract and a new 5-step model begin. If no, then evaluate again if existing contract is terminated and a new contract is created, and if yes, then allocate variable consideration to existing performance obligation to the extent applicable, and allocate remaining change in transaction price to performance obligation in the modified contract. It is possible that contract is simply modified, for example, incentive amount is increased. In that case, allocate change in transaction price on the same basis as at contract inception. Please also remember that while doing reallocation of the transaction price, change in standalone selling price after contract inception has to be completely disregarded. Meaning, change in transaction price after contract inception will not alter transaction price allocation percentage to each performance obligation. Though use of relative standalone selling price is the default method for allocating transaction price to each performance obligation, but standard does not preclude use of other methods to allocate transaction price if that is more appropriate. Okay, so this concludes part 5 of this 7-video series. I hope this video did help you get better understanding of the transaction price allocation concept, and if it did, then that's my reward. Thank you so much for watching. We'll see you soon in the next video. Thank you.